This episode is brought to you by Koyfman. Koyfman is one of the fastest growing platforms for financial data and analytics to research stocks and understand market trends. Imagine a Bloomberg Lite with tons of high quality equity and macro data, a powerful graph engine that can show it all clearly, and a user interface that doesn't look like it was built in the 1990s. If you're an individual investor, research analyst, portfolio manager, or financial advisor, do yourself a favor and check them out. You won't regret it. Sign up for free at koyfin.com. That's KOYFIN.com.
Hit it.
It's Friday, September 24th, 2021, episode 150. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome to the show William Nutting, author of the terrifically entertaining and informative newsletter NutStuff. We have a great discussion spanning a range of topics, from the problems with Amazon to learning about his favorite motorcycle company. Then, recently barred from the FinTwit Brotherhood of Technical Analysis for a series of Crayola crimes. In this week's Talking Chart with Patrick, we find out about the new group he founded, the Alliance of Technicians. By the way, their slogan is, "We demand to be taken seriously."
And this week in trading history, we talk about the Plaza Accord. We end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way. So stick around. We got a great show. Lena, hop on. What beer are we drinking this week?
So today, Patrick in Prague is drinking Pilsner Urquell. I don't even know how to say this properly.
Yeah, no, you said it right.
So, Patrick, you're in Prague this week.
Yeah, I
International Man of Mystery.
Yeah, I'm back in Vienna actually on Monday doing the Huddle Piss Up. I've got 5 or 6 of our listeners that have reached out to me.
The small Vienna edition Piss Up in Europe.
Why not?
Yeah.
When in Europe, you
can't do a Piss Up.
Absolutely. So,
okay.
so
I'm
yeah,
sorry
I'm
to interrupt. So
back.
what are you drinking? You're drinking a Czech beer?
Yeah, this Pilsner. It's the one of the more popular beers out here, and it's it's a wonderful, crisp drinking beer, and I'm enjoying it. What are you guys drinking?
I'm still plowing through all my beers that my buddy Andy gave me. How about you, Lena?
I actually have a wicked heartburn, so I'm staying off beer for a couple of days.
Just a couple days.
I'm just going to take a quick break and then go back to it.
Oh, there you go. All right. Okay. Kev, throw in a disclaimer.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include rheumatoid arthritis, Ethereum deliriums, and then gametal warts. Hate those gametal warts.
No, that's horrible. That's horrible. All right, let's get to our guest.
It's our great pleasure to welcome to the show today William Nutting. William is one of those guys kind of like me. He's a little bit tough to describe, so I decided to let him do it. Welcome to the show, first of all, Will.
Kevin, thanks so much. You call me Will. Definitely.
And how would you describe yourself?
So what am I? Well, I guess I was a non-graduate. I'm a non-graduate student from the School of Common Sense when it comes to stock markets. And I worked for most of the big US investment banks. And I guess I had a kind of Damascene moment about 3-4 years ago when I really wanted to start writing my own thoughts and my own views. And I felt that the really interesting newcomers to the stock market didn't want what a bunch of grumpy, bald old men and their approach to the stock market was. What they really wanted to do was step away from it and realize that actually investing in markets and stocks is about common sense. It's about the real world. It's about relating it to the things that you do in your day-to-day life. There's a lot of psychology in it. There's a huge amount of common sense in it. There's bravery. There's not running with the crowd. And so I guess I just sort of wanted to back away and approach stocks and markets in a different way. So I have done that by creating something called NutStuff, my name Nutting Stuff. I created it as a subscription business. I write 3 times a week. And it's simple. It's designed to make you think. It's designed to make you question. It's designed to make you laugh. And it's designed to make you money.
Well, it does all 3 of those. It does all 3 of those for me all the time, Will. So I love reading it. Let's actually just, before we get on to any of those things and talk about your approaches to the market, let's learn a little bit about how you came to get into the markets, and obviously everyone can tell from your accent you're British. Why don't you tell people a little bit more about yourself and the journey to NutStuff?
Well, I guess it started really age 7. Despite the fact that my parents loved me, they sent me off to boarding school, and I think boarding school is a very sort of seminal moment because it forces you to approach real life. I always say real life is boarding school. You're amongst your peer group. Your parents aren't standing on the touchline, and you are forced to to get on, and it's dog eat dog a little bit.
Is it a little was it a little Lord of the Flies?
I think it was a little bit Lord of the Flies. I mean, I think I got in at the tail end when bullying was really kind of stepped on in a big way.
Okay.
And as I arrived I went to a boarding school down in Kent. I then went to a school called Eton, which a few people have probably heard of. And just really when I arrived, what they used to call fagging, which is a word you have to be careful of. But fagging was kind of school where you had basically, it was a sort of a slightly anesthetized version of slavery at schools, where big boys used to employ younger boys to do kind of menial tasks for them. And that really had been abolished. But yeah, was it a bit Lord of the Flies? On occasions, a little bit, yes.
Right. So you're there at Eton, and for those who don't know, Eton is the school that the Kings go to. I was lucky enough. I actually was not the greatest squash player, but good enough to make my kind of provincial team. And I had the good fortune to go to Eton when I was grade 10, so like 1986, and we got to play your school. So were you there then? Could I have?
I was there then.
Oh,
I was there then, and I was a squash player as well.
Oh, well, who knows? We might have played way back then. So it's a very prestigious school, and you graduate from there. What's your next step?
So graduated from there, and then when I was at Eton, it was interesting. There was a big backlash against Oxford and Cambridge, and I don't think I was academic enough to get into Oxford or Cambridge. But I took my SAT and achievement test because a lot of the American universities were quite keen to have a bit of diversity, and I guess they wanted to have English public school students. And so I took
some white guys from the fanciest school in England. It's
white
great
guys
diversity.
from the fanciest school. Well, yeah, we used to have these sort of enormous testosterone-driven Americans would arrive, and they'd go rowing, and and they'd come charging down the pitch in sports, and we'd just get out of the way of them. Lots of shiny white teeth and giants. So I basically. I did my SAT and achievement test, and remarkably, I did pretty well in them, and consequently, I was offered a place by a couple of American universities, and at the time, I think I kind of felt like I'd been institutionalized at boarding school for long enough, and so I went off to Africa, and I had family over there, and I traveled and did kind of a bit of a sort of like the kind of gap year thing of having my eyes opened and doing some interesting things, and at that time, it was interesting that the kind of Lloyd's insurance market issues hit in England, which is a big issue for a lot of my parents and their generation. And I think my father took one look at the fees for American University and thought, I'm not sure I'm up for that. And so the logical thing was I came from a family that had been in the British military for a bunch of generations. And there was a regiment called the Irish Guards, which was the Irish part of my family, my father's side of the family. And so I went down the army route. I came back from Africa. I went to I arrived at Purbright, which is the guards depot. And as I arrived on the station platform, there were two guys with me, and one was 6'6", and the other was 6'7". And I'm 5'7", and I thought, I think I've arrived. It was like being back at Eton with all the Americans who rode.
That's right.
Anyhow, one thing led to another, and I did my military training and went into the army and had really just an incredible experience. And I think it was a degree from the University of Life, which is a trite thing to say. But I think the combination of having been to Eton, which was in many ways almost like a university of schools, and then the army, which I think taught one just some really good basic building blocks of life. I came out, very young, but having traveled and having done some interesting things, having met just an extraordinary collection of amazing people.
So
that was really...
I just want to jump in here, Will. I didn't tell you this story, but when I was in Eton, I got there and they asked me my name, and I told them it was Kevin. And they said, "Oh, don't tell anyone that's your name." And I said, "Why?" And they said, "Well, that's an Irish working class name." So I was kind of surprised when you told me that you were part Irish and you still got in.
Well, listen, there was a few that squeaked through the cracks.
Okay, so you graduate from, or you complete your army training, and then do you get a job on, back in the city from there? Or
So essentially, I came out, and I think I worked out that I was quite good at selling stuff to people. I enjoyed selling, and I was one of those strange people who, if I walked into a room full of 400 people, to me it was all upside. I didn't know anyone, they didn't know me, so my job was to try and sell them something or achieve something positive from it, which is probably shamelessly commercial. And so I thought, well, I can either go and sell bombs and missiles, or I can sell drugs, or I can sell stocks. And I thought the only socially acceptable one was stocks, and I could understand stocks because it was like stories. And I rang a few people, and before that, I'd done a few other jobs. I'd sold portable lighting. I'd sold beds. I mean, I'd sold pretty much anything to anybody that would buy it. And this gave me round to the fact that I knew that I could sell. And so I got a job working at Fleming's in London, which was a Scottish investment bank. And to be honest, I didn't really enjoy it. It was a bit too much of an extension of school, and I really wanted to go and work for kind of a slightly more sort of meritocratic organization, and I left, and then I really ended up going into the world of US investment banks, and I started my life at Cowen. I was the last employee hired by Joe Cohen, who was a sort of giant of Wall Street who ran Cowen. They were then bought by SocGen, then Bank of America, and then Lehman Brothers, and the rest is a long story.
So now, during this time, were you an institutional equity salesman? Is that your role? Or
well, fun enough, the first place I went to, and it's a relevant thing to really what I do now, is I work for a little hedge fund in London called European American, and the principals of the hedge fund met a guy called Jeff Gordon, and Jeff Gordon was a really inspirational guy, and he built a thing called off the record research, and off the record research. 25 years ago, before internet, before email or anything, was effectively journalists writing research, journalists and market researchers writing research on things like trends in athletic footwear. So how is Nike doing versus how is Adidas doing versus Reebok, etc. And we take this very real research, and one of my jobs was to go and try and sell it to institutions. And of course, people would say, "Yeah, here's a check for a couple £100 or whatever it is." And so that was my real first experience of selling something that wasn't sort of traditional Wall Street research. And it was a very far-sighted product at the time. But after that kind of really gave me the flavor for selling research. And various clients of mine said, "Listen, stop selling that rinky-dinky product and go and work for a proper investment bank and sell deals and sell research." And so that was where I really ended up on the kind of mouse wheel of US institutional sales.
Okay, so you were institutional equity sales as opposed to corporate finance.
I was institutional equity sales,
right. Okay.
through and through, exactly.
Yeah. Okay. And so you're there. You're doing that. And are you in New York at this time, or are you in the city?
I was in the UK, in London, which is always an interesting thing. I mean, and the US market was my market. So what was great was the US market opened at 2:30 London time. So I always used to think that it was late nights, but when I got in the morning, I had lots of time to digest what had happened in terms of earnings and what was going on in the market. And so I think by the time I got a call out to clients kind of, mid-morning, my sort of US counterparts were scrabbling to get away from home and get in the car and get to the office. And by the time they got there, they kind of, they got a quick synopsis of what had happened on the morning call. And then it was a sort of giant mass vomit into their clients' voicemails, which is how it was all done in those days. And so I think we had actually quite an advantage in broking the US from London.
But you had to stay up till late at night.
Yeah, so market closed at 9:30 at night. So we had to stay up late at night. So that was what you won on the swings, you kind of lost on the roundabouts.
Yeah, and then you had the lunch was your dinner at the pub, right?
Lunch was dinner in the pub. But then again, we exactly, the market closed and we we got to go to the pubs. That was fine.
That's right. Okay, so you're there, you're doing this, you're going back and forth, and do you stay in London this whole time?
No, I spent some time in Boston when I was working for Cowen. I spent some time in San Francisco when I was working for Montgomery, which became Bank of America. And, I spent a huge amount of time traveling around the States, seeing companies, doing roadshows, and as I say, and then I eventually end up getting married. I married a Canadian. We made 7 years. I met her in England. We had 2 kids, and then my kids actually now live in America. So my kids have lived in America since they were 2 and 4. So I always had a reason to go back to the States. So I have a very kind of US mindset to
were your clients like the traditional mutual funds / pension funds, or were you also covering the hedge funds?
Well, I guess I covered quite a few hedge funds, and I covered pension funds, mutual funds, and then kind of it was the emergence of the family office, and at that stage it was a very kind of pension fundy world for US equities in London, really.
And over the years, you must have seen the markets change. So you've, in essence, had, 3 decades watching the equity markets. What would be kind of the biggest change that you would highlight during that period?
I think the efficiency of markets is the first thing. I think the second thing is the commoditization of really everything on Wall Street. I mean, I've always said that in my 30 years of doing this, the only 2 things that I don't think can be commoditized are good people and good ideas. And I think that still applies today. And I don't think you need to work in an investment bank or work in a hedge fund to be a good person with good ideas. So that I think is the natural segue to the place that I'm in now. And I think the final thing is that the players in the market, this emergence of quant funds, this emergence of momentum players, this emergence of the machines. I view it as, a lot of people viewed it as a threat. I actually view it as opportunity, because I think the great thing about the machines is, as smart as they are, you can kind of see where they are and where they aren't, and that's always been one of my things. Is as I've seen these new players come into the market, it's kind of slightly trying to stay ahead of the curve. Wayne Gretzky always says, skate to where the puck's going, not where the puck is, or where it's come from. and that's always been my approach to looking at markets and commentating on markets and buying stocks and all that kind of stuff.
So I can tell you, you're a good Canadian Canadian husband there with the Wayne Gretzky analogy. All of us Canadians appreciate that. Let's talk a little bit more about that idea about how quant funds have changed and how you could see opportunities. So what would be kind of an example of a situation where you saw a quant fund come in, move something for whatever reason, and then that gives you an opportunity to either buy it cheap or sell it expensive? Which way? Do you
I think the most, let's talk. I could go back, years and say things, but I think very recently was this classic example. Go back to 2020 when, COVID hit. It was an unknown, and as Donald Rumsfeld always said, it's the unknown unknowns that kill you. And the market had that huge dive in March. And then what was very interesting was, that it was clearly the world locked down. We got into this understanding of the world was going to go digital, and everyone was going to watch Netflix and have food delivered and stay at home. And so it was manna to this huge concentration of market cap that exploded in the FANG stocks. And I would always make a focus of looking at equal weighted markets versus index weighted markets. And it was watching just how big and what a machine these 7 stocks were becoming. At the same time, of course, the areas of the market that were getting the biggest inflows were tech funds and the ESG green funds. And so on the one hand, you saw all the machines, a lot of smart money and a lot of dumb money going into these huge trends. And they were working and they were expanding, and the stocks are working incredibly well. And we all know what happened from the March lows to a couple of months ago. We were up 100% in the indexes, and it was all fun and dandy. What interested me most about that, though, was that, of course, I was happy to play and recommend and look at a lot of those stocks. But at the opposite end, it was almost more interesting to see what was being forgotten. And the things that no one would touch, were the hydrocarbon stocks, were the coal stocks, were the natural gas stocks, was uranium, was nuclear. And I genuinely was one of those people, 18 months ago, or maybe 14, 15 months ago, who was recommending and looking at coal stocks. And of course they were tiny. And I was just making the point that then none of them are in the indexes anymore. They've all, all the bigger majors, if you remember, were kicked out of the Dow and kicked out of the main indexes, and they just became forgotten. And I think commodities and energy went to less than 2% of the S&P's weight. And I remember thinking, if I got a piece of paper out and I wrote on the piece of paper, what are the things in life that I can't do without? I can't do without oil. I can't do without the building blocks for all this kind of stuff. And so, to me, that was the classic example of where you got this huge bifurcation, and that was opportunity. So, the way I was structuring the NutStuff portfolio, which we can talk about later, was to say, listen, you've got to have this barbell. You've got to kind of go with what's going, where all the fashion and all the flows and all the big money is going for very logical, environmental, socially responsible, globalist reasons. But you've got to start building contrarian positions in forgotten things. And it's that great mantra that I always remembered, which is when everyone loves something, it must go down. And when everyone hates something, it may go up. And I'm by nature kind of, if I walked into a room and there was a kid in the corner with pedal dash glasses who no one was talking to, I was the alpha personality, slightly weird alpha personality, who would always go over and talk to them because they tended always to be the kind of interesting contrarian kind of thing.
And the other thing you mentioned is you said the markets have gotten a lot more efficient. So this is kind of how they're inefficient from a kind of longer term perspective. How have they become more efficient? And I'm assuming you mean on a shorter term perspective.
I think they become efficient on a shorter term basis because everybody has the data. I mean, when a company reports, when a company's reporting earnings, I get the reports from the big investment banks, and people will send them to me saying, there's a X% probability that in the last 14 quarters this stock goes up 7% on the quarter, and so all the quant funds and all the machines can play that kind of that high frequency thing. So I think it's very, as I say, I think it's very efficient, but actually for a stock picker and for an alpha generator, when you've got 25% plus of the S&P's market cap in 7 stocks, I think that level of efficiency is actually now playing into the hands of people who are willing to do the work and be contrarian.
Right. The other thing I think that's happened that I've noticed over my decades of watching this is that the cycles seem to have sped up. If there was a story that was hot, let's just say that the hedge funds would buy it first, and then maybe the pension funds would grab it, and eventually the retail would come in. And this process would take, I don't know, a few months, and maybe a month if it was fast. Now you're finding these things are happening in a week. And it's been quite shocking to me how fast the market has become. Have you noticed the same thing?
I think that's right. I mean, I always used to think about it as driving into town into a sort of a mid-America town in a car, and as you drive in, there's kind of a bar, there's a bunch of bars on the left-hand side, and you can sort of see the most popular bar with the flashing lights and the music and everyone's rolling up and parking outside it, and someone opens up another bar on the same side of the road, and how many people will start to move from that bar to the other bar, and then this the bar on the right hand side of the road that's looks miserable and there's no one there, and the lights are dim, but the beer's half the price or a third the price, and it's a case of in the days of old it would take lots of time for the cars to move from one to the other. Now it's like if you stood on the road, everyone's running backwards and forwards across the road the whole time in real time. And I think, and so to me, you've just got to kind of stay ahead of, slightly stay ahead of what's going on there.
I knew, Will, that you were our kind of guy when you're making bar analogies to explain how the markets have sped up. Okay, so let's talk about some of your, you mentioned some of your picks. You mentioned that you've been bullish on the FANGs as that whole move had come, and then also the hydrocarbons. Why don't you explain where you are on that trade now, and what you're not recommending, or what you're talking about and highlighting?
Well, I think I think the interesting thing about doing what I do is, I'm a stockbroker, not a market broker, or I'm a stock picker, so I always view a portfolio as a little bit like a sports team, right? If I ran a sports team, you don't want to have a team of goalkeepers, but you don't want to have a team of strikers. And so what you're trying to do, I think, is you're trying to build a portfolio. It's a little bit like in the military where you have different skill sets. I think, in your sports team, you want to have offense, you want to have defense. You want to have your medic, you want to have your weapons guy, your transportation guy. And I think in stocks, I kind of try and look at sectors and think about who are the stocks inside the individual sectors, not just the market. So when I look at tech, for example, I look at the seven FANG, the seven big FANG stocks. I think they're all very different companies, and I think what people forget about the FANG stocks is they're not just seven companies. They're probably 700 or 800 companies, and they've been built through incredible acquisitions of unbelievably small entrepreneurial companies and some big ones. And so Google is a fundamentally different business to Amazon. So I would make a very resolute case for the ownership of Google, and a very resolute case for not wanting to own Amazon. And I think Amazon is actually quite a structurally flawed business, despite the fact that it's amazing and brilliant to be a customer of it. I think it's very badly analyzed, and I think when you fully capitalize the Amazon Web Services business, and you really look at Amazon losing their competitive edge as an online retailer in terms of sales tax and such like, I think the valuation, and I hesitate to be negative on a FANG stock because of valuation, I think the valuation on Amazon actually is ludicrous. I would argue that the valuation on Amazon is as ludicrous as the valuation is on Tesla.
Okay, so I'm not going to, unfortunately, I'm going to have to jump in here because I can't let you get away without exploring this, because it's been a long time since I've heard anyone poo-pooing Amazon, and I find it fascinating and it intrigues me. So can we go through the reasons for your skepticism again? Number one was the way they amortize the AWS business.
Number one, I think, is the capital intensity of the web services business, and the intensity of the web services business, and the fact that if you look at where the real land grab is amongst the FANG stocks, it is in that web hosting and the web services business. So I think there's going to be what you guys would call a kind of crapshoot in that game. Okay. Secondly, it's an incredibly capital intensive business. So I don't think you're going to have expanding margins. Secondly, Jeff Bezos has stepped off, and there's a new sheriff in town. And I think that for big, incredible founder driven companies like Amazon, when that happens, it's a little bit like when corporations name sports stadiums. I think hubris steps in. And I think the most fundamentally important thing about Amazon is that, as I say, they had this incredible advantage in terms of pricing and such like. And now that the sales tax elements are beginning to feed in, they don't have the same degree of advantage that they had before. So I think you're paying a very heavy multiple for a company that really has, I don't think, much prospect for margin expansion, and is becoming an increasingly capital-intensive business. But as a customer, as a prime customer, it's an utterly brilliant experience. And so, when the moment you try and kind of, the moment you try and be negative on it, you get a lot of pushback.
Okay, and then you contrast that to Google, which you think has.
Well, paid search is I think paid search is the single best, arguably the single best business model ever. I mean, I think YouTube is a phenomenal business. Lots of people fear Google being broken up. I think if Google was broken up, the incremental value that would be created from a Google breakup would be much greater than the current share price. So to me, I think Google is in this. I think Google's search business, there's so much technology embedded in that now that I would argue that there's probably a national security element to Google being able to turn around to the US government and saying, "Listen, guys, you know what? We know we know we've got the information, kind of leave us alone.
That's funny. So now, would you actually recommend that as a pairs trade, or is this just something that you would highlight as, oh, well, listen, if you're going to own tech, this is the tech to own?
Well, I think it's did you ever see a film called Minority Report? There was a film called Minority Report that with Tom Cruise.
It's Tom Cruise. Oh yeah.
And he was a kind of futuristic detective, and he used to have all these screens, and he used to be able to move his hands around all these screens, and he could bring all the stuff in. And I always wanted to have that technology to look at markets. And one of the things what it's done to me is to make me realize that I need to pick my battles. Okay. And so picking a battle on trying to short a stock that is one of a club of 7 of 25% of the market value, I just think it's a battle I don't need to take. That's not a battle I want to have. So I think I'd rather have the battle of kind of, of not owning Amazon, but owning a bunch of other, but owning, Spotify, Twitter, Snapchat, etc.
Okay.
On the opposite side of it, I think that's the way I would look at it, versus having one fang against another.
Right. And when you're thinking about that portion of your portfolio, do you worry about any shifts that we might see? Because there has been a huge run into tech because of the whole COVID, and we've had lower interest rates, and it's been just you want to own the longest duration asset, and arguably tech is the longest duration asset out there. And so do you look at this and say, I could see a situation where, although I love the Google business, we're going to have higher rates, and this business, all of these tech stocks are going to be under pressure in the coming years?
I see no. I mean, I've as running an active, running an active fund, I've constantly found myself being beaten to death for the last few months by the S&P and those stocks in the market. When you actually go through the earnings reports on a lot of these big tech stocks, there's no doubt about it. There is going to be some comparisons and some weaknesses going to set in. And so, to answer your question, I think someone like a Google, could Google miss on an advertising revenue number, for example, sometime in the next few quarters? I think it's eminently possible. So I just think at the moment, positioning is incredibly lazy. I think there's way too much lazy money sitting in these big tech stocks. And it is incredibly logical that the Fed needs to start thinking about preparing the market for taking the drip out of the patient's arm and seeing if the patient can walk down the corridor on his own. And I think in that environment, if we get a 10-year that pushes back up towards 2%, which it should do in terms of where we are, that's positive for the market. But I think it's absolutely not positive for the multiples we're going to pay for some of these big growth stocks.
So have you changed any of your portfolio based upon that happening?
No, I mean, yes, I have. I mean, I would say that when I look at the barbell in my portfolio, I have much more energy now. I have many more financials. I'm looking at some transportation stocks that I haven't looked at for a long time because I think they would be the next. They'll be the sort of final movers. But obviously, there's some disruption there going on from supply chain and issues from ships stuck in canals and all that kind of.
So let's explore that further. If you foresee a situation where the Fed comes, withdraws the amount of QE they're doing, we get some tapering, combine that with, I guess, the inflation issues that we've had, and you see interest rates heading higher, and therefore you're more attracted to value type names. And you mentioned 3 different sectors there. Could you go through each one of them, tell us why you own them, and maybe give us a name or two?
So, I mean, let's go. So the answer to your question is yes. I mean, I think it's very logical and normal that if we hadn't had the COVID panic and the COVID situation, that I think we'd have had a 10-year well north of 2%. And so I think it's very logical that rates get back up there. Now, I also think that the Fed is backed into a corner in terms of the ability to raise rates to significantly higher levels is actually fairly mitigated. So I think it's the psychology of higher rates that's going to cause this more than the absolute where rates will move to.
Okay,
but no matter what, when I look at the baskets and the things that I want to add to, I think financials, balance sheets have never been stronger. for the financials. It's not the financials that have been in the penalty box this time. I think as much as we can get excited about, crypto and alternative sources of finance, the reality is it's the banks and the financials, and of course some of the disruptors that I also, am very focused on that I think are, going to benefit from higher rates.
Why do you think the financials have suffered so badly? Has it been all rates?
I think it's been rates. It's been regulation, and it's also, I think there's been a sense of them having their lunch eaten by, financial disruptors. So whether it be Square, whether it be PayPal, these guys coming in and sort of taking all the best things off the table. But when you look at the balance sheets and you look at their ability to pay dividends now. Some of these are just ridiculously cheap, and I'd single out I like the idea of a Mormon bank, so I take a look at a bank like Zions Bank, for example, who I don't think have written off a loan for 3 or 4 years, is phenomenally cheap, incredibly well-run bank, and a sort of classic, to me, a classic kind of mid-cap.
Is it almost like you're buying financials today is like buying natural gas and the hydrocarbons 6 months ago?
Yeah, I think that's exactly right. But I think you can buy natural gas and hydrocarbons still today.
Okay.
Because when you look at where the spot prices are for these commodities, and you start putting them into models, some of these companies are trading on 25, 30, 40, 50% free cash flow yields, and I think that again, this incredible misallocation of capital into future sources of energy, which of course I want for my children's world and my grandchildren's world. I don't want a world addicted to polluting hydrocarbons. But let's just not forget that 80% plus of the world runs on hydrocarbons, and so a phenomenal and fundamental lack of investment in the last 7 or 8 years. The solution to that is going to be higher prices, and those higher prices are going to make your Royal Dutch Shells, they make your Exxon Mobils, incredibly attractive stocks. Also, let's not forget to go back to what we were saying about fixed income on the bond market. Where can I go for my inflation protected yield? And I can buy Tesco's in the UK, but I can also buy big oil companies. So I think it's a great situation now for owning a lot of these what I call inflation protected yield companies as a very good counterbalance to what I call a lot of lazy exposure in FANG and the likes.
And so part of the reason I think that some of these companies have gone cheap is that there's been a conscious decision by both governments and investors to starve the whole industry of capital. And I'm with you. I think that the logical conclusion of starving an industry of capital without changing demand is that you have a higher price for the commodity. But one of the things that I think about it and worry about is whether anyone will ever pay up for these companies ever again. And yes, I guess we're just going to have to live with these things being big yielders, and it could be that they just keep making money and nobody or few people buy them. You were around and trading stocks in the 90s when tobacco stocks were in a similar situation. Obviously, tobacco is much worse than hydrocarbons, but do you see any similarities there? And do you have any insights?
I do, and I own 2 tobacco-related companies. I own Philip Morris International with this IQOS business, which is just an extraordinary and incredible product launch that is the next iteration is going to be the equivalent to basically smoking a cigarette that's going to be much better for you than cigarettes. And I own a company called Turning Point Brands, which is more of a special situation, small mid-cap stock that's doing a lot of stuff in the world of vaping and smoking papers and such like. So I think the answer is yes. If you look at the big tobacco stocks, they've had their wobbles, they've had their downturns, but realistically is the addiction to tobacco is not a dissimilar secular theme to the addiction to hydrocarbons. And we all want a solution. And of course, BP's board is desperately wanting to reinvest into new energy and the future of energy. But realistically, what the world needs right now is the grubby stuff that BP pull out of the ground.
Right. Okay, so we went through the financials, we went through energy, and then the third was very interesting, something not a lot of people are talking about, which is the transportation sector. What attracts you there?
Well, I think it's, I think it's the nuts and bolts of how stuff gets moved around. So I've owned since actually really for the last 2 years. I've owned it's a lot of shipping companies, and the shipping companies are a little bit like what you were talking earlier on, which is that everyone's assumption about shipping companies was that the ships are old, they've got old engines that are environmentally unfriendly, that just as soon as day rates go up, the people start building ships left, right, and center, and pricing will come down from day rates and such like. But actually, what's happening is a lot of these ships have put scrubbers into their engines, and day rates are really strong. So although you haven't had big capital appreciation on the stocks, when you look at the dividend yield on Frontline and Scorpio and these things, they've got huge yields. And so I kind of sit there thinking, God, these stocks have gone nowhere. And then I look at the yields and suddenly start to bake in the performance with the yields attached, and they're pretty attractive. I think the railroads. Listen, if the oil price continues to go where I think it will go, which is significantly higher, then that's going to drive substitution onto the rails, and the rails in the States have become much more consolidated, much more efficient, and some of these stocks are really becoming quite cheap now. So I think they are, they're logical. To me, they're very logical stocks to own.
One of the things as I sit here and listen to the things that are attracting you with these stocks that are kind of almost forgotten about and are trading cheap with great yields or great cash flows, I think about back to the flash crash, the quant flash crash. What was it? Was it 2007, 5? I can't remember when it was, but there was a period when we had all these. It was at the kind of the start of all the quant times, and we had this huge kind of rotation where some stocks were up, like sectors were up 30% and others were down 20%. And funds like AQR were getting just absolutely annihilated because they had all this levered up 2-for-1. First of all, do you remember that scenario, that period? And could you see that happening again given the setup that we're experiencing?
I mean, I remember that period really well, and what's extraordinary is I remember other periods where you own a portfolio of kind of current in vogue technology stocks, and you also own over the time I've owned contrarian positions in oil drillers and offshore drillers and everything else. And what's extraordinary is that the oil drillers are so cheap and the technology stocks are expensive, and you have a 5 or 10% correction, and the oil drillers go down more than the tech stocks. And so the answer is yes. The flaky hands. Some of this stuff is in flaky hands. I think the value trade is in more solid hands now, and I would again just encourage anyone to look at where energy, commodities, raw materials, where the weighting is in the S&P, and it's nowhere. It's absolutely nowhere at the moment. So I still don't think that there's huge consensus positioning in a lot of these things, and I believe that we are in this period of commodity price inflation, and for the reasons that I've said.
So when you speak to I'm sorry to interrupt, but when you speak to the pension funds, and I'm assuming you still have some contacts, or you have a feel for this.
Yeah, no, I do. I do.
Are they very interesting, Will? But the reality is that we're still we're stuffed to the gills with all these tech stocks. Like, do you think that there's
I think they're stuffed to the gills with tech stocks. I think a lot of I hesitate to say it, but I think when you look at the performance of a lot of pension funds, you understand that pension funds are a little bit like charities. If you get and I've just had this experience, you get a charity and you want to go and do something amazing with some beneficiaries of a charity, and then you suddenly realize, you look at the charter of the charity, and the charter basically it prevents you from doing anything incredible and amazing with the people who would benefit from the charity. And I think a lot of pension funds are a little bit like that. They can't invest in the most interesting stuff, and so they mean revert to owning, big tech. They mean revert to owning consumer staples because they have dividend yield. And that really, I think, still to me is the opportunity, because when I look at the most exciting trends and themes that I look at today, it's meat replacement, it's the removal of intensive farming, it's robotics, it's consistent and reliable power. Just to name a few things that I think are going to be vital and incredible. It's the food chain to the electric vehicle explosion. So on the one hand, I can advocate owning hydrocarbons and gas and coal. The other hand, I can advocate owning lithium and beneficiaries of all this new energy stuff that's going to explode over the next few years. The question really is when I just have to do the handoff, when do I sell my coal and natural gas positions and end up buying my solar and alternative energy stocks, and that's just timing.
So would you mind taking a couple of your most exciting kind of under the radar names and telling us the story?
Yeah. So, and I think, okay, so intensive farming, 20% of global emissions come from the food chain. Okay. And the reality is that a cow takes in 25% more protein than it produces. Okay, when you kill it and turn it into meat. And what's extraordinary is that synthetic meat is going, as much as everyone rolls their eyes and goes, that's disgusting, what a horrible thought. The reality is that synthetic meat is going to become a huge business. You've seen Leonardo DiCaprio this week make a significant investment. And most of these companies are private companies, so they're off the radar screen for most people. But there is a UK company called Agronomics, which was put together by a great friend of mine called Jim Mellon, who I think is one of the sort of smartest, most interesting contrarian investors out there. Jim's been vastly successful in all sorts of different areas. But Agronomics is a publicly traded company, but it's a 200 million market cap company. But that would be, for me, something that I think is going to be, has got some extraordinary companies in its portfolio, and I think is a hugely exciting business to look at.
Okay, that's great. Can we sneak one more out of you?
Well, just thinking thematic. Well, okay. So I'll tell you something else that I think thematically is interesting is that COVID, and this, I guess, slightly feeds to what I do, which is that I can talk about US stocks, and I've done US stocks for years. But in some respects, for your US listeners, why NutStuff? What's interesting about what I do? Well, one is I try to have a global view. Secondly, I'm very thematic in the information. I think I have managed to aggregate, and I have some extraordinarily good and wise and incredible sources, which is humbling after 30 years that people still want to talk to me and feed me with information. And so when I can take all that information in, sometimes it's very easy to see what the US company is to own. But actually, some of the really interesting stocks that I own now are European stocks. So one I would use is the whole explosion that happened as a result of COVID of the outdoor life. Parents, all of us trying to get away from our screens because we live in a digitally obsessed and focused world. And I remember seeing when Joachim Zeitz took over at Harley Davidson, and Harley Davidson got down to about $16 last year, and I had owned it and I was recommending it. And suddenly I began to see what Harley was doing, which is they were beginning to become a bicycle, an e-bicycle, an e-bike business. And Joachim Zeitz is a brilliant CEO. And anyhow, he's done an incredible job at Harley Davidson. And he took the stock's gone from 16 to 50, back to about 38 now. But I think they are going through a huge renaissance. But not only is Harley Davidson interesting, it actually got me interested in looking at the whole motorcycle market. And the explosion in the motorcycle market with clothing and imagery, and it's kind of like Mad Max meets Brad Pitt, all young guys. Motorcycling's becoming cool again off road, and there's a company in Switzerland called Pira Systems, and they own KTM motorcycles. They own Husqvarna. It's a $2 billion market cap business, incredibly well run, very tightly held. And I think this is another one of those sort of classic sleeping potential giants at 2 billion that would excite me. So huge diversity, meat replacement and motorcycles. There you go.
So
there's no vertical. There's
Sorry, I didn't mean to step all over you there. For those that are interested, the symbol is PMAG, Paul, Mary, Apple, Gordon on the SW exchange. I guess that's Sweden. Now, I was actually
Swiss.
Oh, it's Swiss. I'm sorry. It shows you
Swiss.
How North American centric I am. So, Will, I have your piece where you mentioned this company in front of me, and it was going to be one of the questions I asked towards the end, but now that you brought it up, I can't help but ask. I take it you are not just a stock owner; you are someone who has used the product.
Well, I am, and actually, I'm talking to you from Switzerland at the moment, and I have a KTM motorcycle in my garage downstairs, and there's nothing gives me greater pleasure than getting on my motorbike as the sun's about to go down and charging off into the mountains. And in fact, I've just my only week off riding was last week this year, and I went with a bunch of ex soldiers who'd been in the military with me, and we were involved in taking some wounded ex-servicemen who'd been blown up in roadside bombs in Afghanistan and Iraq and such like, and we took them to into the desert in Morocco and out towards the eastern end of the Sahara, and we used the KTM product, and they are genuinely unbreakable.
Okay, so you have some pictures. Now, first of all, it's a very great thing that you're doing with the soldiers. You got to tell me more about this. So you take these, you guys all get up, you get yourself some motorcycles, and you go out into the desert. Are you sleeping out in the desert, or are you coming back to the hotel? We stayed in a couple of hotels, but let me tell you that one of the hotels had no running water and no sewage, and 22 guys waking up in a hotel in the desert in the morning. That's not pleasant. We spent a night sleeping out, and genuinely sleeping out, and then we stayed in a couple of moderately nice hotels. But on the whole, it's a bunch of ex-soldiers, and it's not designed to be luxury. And I see you going over some dunes and stuff. Are you too old to be doing real stupid stuff, or are you?
Yeah, definitely. I'm definitely too old. My midlife crisis is full in. But I think the important point is, it goes back to what I said at the very beginning of this, which is that I kind of wanted to get away from. One of the things that made me so cynical about Wall Street was that I looked at teams and teams of analysts working for investment banks who were kind of fat, balding, middle-aged guys. Who live for 2 weeks holiday a year, and I found that all my best investments and all the best ideas I have come from my life experiences, come from talking to my children, coming from talking to other people's children, getting a piece of paper out and asking 25-year-olds and 15-year-olds, what is it that you couldn't do without? What is it that you would beg, borrow, and steal to pay more money for? And writing those things down on a piece of paper, and then writing next door to the piece of paper which companies those are on the stock market, and then turning around to those kids and saying, listen, if I give you $1,000 when you're 21 and it compounds at 10%, it will double by the time you're 28. If it compounds at 4%, it won't double until you're 42. And if you keep it in the bank, it will double in 192 years. So get your money in the market and go and buy some things that you genuinely are interested in. And actually, I think that advice is the most valuable advice. And then I look at where market caps and valuations are, and people tell me what forward multiple or what Cape multiple the S&P trades on. I actually don't really care. I think there are interesting businesses and uninteresting businesses. But actually, to me, the overall stock market is, I think stocks have compounded at 7% for the last 100 years. We'll have some lower than 7% years and higher 7% years. But the reality is there is no alternative to owning stocks. And I think recommending stocks, the people who should be listened to, are people, I think, who are being a little bit more real world about it.
Oh, that's fascinating. Okay, let's go through. We always ask at the end our guests some questions, and one of the questions that one of my favorites is: are great traders or investors born or made? And I was wondering where you came down on this, and also while you're there telling us that, do you have any stories of great investors or traders and of kind of wisdom that they passed on to you?
God. Let's go to the first bit first.
Okay.
Are they born or made? I don't think they're born. But I think the qualities you're born with can be conviction and bravery. But I think one of the great mistakes a lot of too bright people make is they overthink things and they overanalyze things, and they have an investment process, and the investment process, by the time they got around through it, the trade is done. So I think you learn, but I think as much as you can learn to be a good trader, I think you have to have conviction and bravery, and I think you have to have that ability sometimes to say, I don't care what anyone else says. I know, I feel it. I feel this is going to work. In terms of, I mean, yes, I've worked with, I've had some incredible clients who are amazing personalities. Chris Benodi is a hedge fund manager in London who whether he's making money for you or losing money for you, it's an incredibly pleasurable experience to always talk to him. Chris Hone at TCI and his team there are just genius, and I think some of the greatest stock pickers out there. Pete Davis at Lansdowne and the Lansdowne team, they've had some good times and some bad times, but Pete still has an ability to look at a business and ask the question or take the key point out that no one will have ever thought about. So the guys at Finley Park in London, James Finley, who's now sort of pretty much retired, one of the great stock pickers of our generation,
So what made all these people such good stock pickers? What do you think was the quality that ran through them all?
I think they were all real people. I think they were all real world people. I think they stood back. I don't think they listened too much to the street. And I think they had a financial discipline on, if you're going to own a growth stock, it's got to earn its consensus earnings number for next year, this year. On the whole, under-levered businesses that generate, high levels of free cash flow, that have got defendable models, are fantastic, great businesses. And then they had an ability to understand high quality compounding models. So I think it was pretty much those simple disciplines to owning stocks. But as I say, a lot of it then was standing back and saying, do I like the management? I always remember James telling me about going to see Clear Channel Communications. And Clear Channel, if you remember, was the big radio roll-up business, and he had a meeting there and with Larry Mays, who was the sort of great iconic leader and runner of Clear Channel, and he eventually said, "Listen, I've got a plane to catch," and Larry Mays drove him to the airport. And on his way to the airport, he realized that his beaten up station wagon didn't have any fuel in it. So they pulled into the petrol station, and the guy came out, and Larry Mays always said, no, I always pump my own gas. And I always remember James saying to me, the guy who runs the best radio, runs one of the best media companies in the world, who drives a shitty station wagon and pumps his own gas, is the guy who I want to be the steward of my money. And I think it is Warren Buffett, Warren Buffett-esque lessons of real world.
And it's almost Peter Lynch, One Up on Wall Street as well, in terms of investing.
Yeah, and it's fun. If it goes back to what you said about FANG, which is, the thing I worry about in the States most, is that there's very clearly governments are addicted to spending. And if governments are addicted to spending, governments have no money. The biggest problem with socialism is governments run out of your money. But ultimately, the only money that governments have is your money. And so if they're going to do this spending, they're either going to have to print it, or they're going to have to find it from other places. And the very logical place to find it from is a lot of the Silicon Valley success stories. And on the whole, I look at a lot of these people, and I don't see the personality and the characters and the humility. And so I'd be, and probably a lot of Americans feel the same way I do, I feel very happy, hitting them with some quite punitive taxes.
Okay, well, we'll let you.
That's comrade NutStuff talking. That's there right. You go.
Okay, Will, your favorite investment book?
Oh my God, I hate investment books.
Really? Okay, then your
yeah, I
favorite
hate
book.
investment books.
I'll let
but
you.
my favorite, I'm not allowed to use the word, but it's a book written by Mark Manson, and it's called The Subtle Art of Not Giving a
Oh yeah.
F-U-C-K.
I've read that book. It's a great book.
And I love it. And what I love about it is that
And
all
by
the
the way, you're
analogies.
allowed to use the word here.
Okay, The Subtle Art of Not Giving a Fuck by Mark Manson.
Yeah.
And what I like about Mark's book is that I parallel to what he says about life and the work-life balance to investing, which is that you have to be selective. You can't kiss all the girls. You can't, you can't look at everything the whole time. You have to be selective in your life. You have to invest your time, your effort, your emotion into the things that give you the best return, and that's emotionally. But in the market, I think it's also picking your battles and staying focused. And so I think it's a good. There's another book I read. I love Who Moved My Cheese, I think was the other one, which is another great kind of crazy.
I haven't read that one, so I'm going to read that one. Who Moved My Cheese?
Who Moved My Cheese? Yeah.
Okay, and the final question for you is, if you could meet the William Nutting of a younger age, let's just say when you're finished eating and off to make your way in the world, what advice would you give him?
Identify the people that you meet who are spouts and the people who are drains, and try and make sure you fill your life with spouts. Always remember the concept of the poverty of wealth. Every time you see people who are very wealthy or rich, just remember that true riches are, your friends, your friendship, your health, and your family. You can only drive one car, you can only live in one house, you can only fly in one plane at a time. The road less traveled is not always easy, but it's never dull. So, take the road less traveled. Smile lots, worry less, be positive, read more, write things down. Kind is cool.
Who knew that not only are you a terrific stock picker, a great guy, but you're also a wonderful philosopher? William, why don't you tell people
please no. Please no.
Why don't you tell people more about NutStuff, where they can find it, where if they wanted to chat with you or get in contact?
So shameless pitch, www.nutstuff.co.uk. Talk to me at nutstuff.co.uk. It's a subscription business. I write 3 times a week. As I say, it will make you think, it'll make you question, it'll make you laugh, and hopefully makes you money. I publish a portfolio on there. It's full of all sorts of stuff. There's no advertising in it. There's a lot of so what. I charge, what do I charge? £1,000 a year or £85 a month. I priced it purposely at something where it's meaningful, but frankly, if I give you one good idea, it's going to be irrelevant. That as I say, 3 times a week, and I just deliver it it's delivered in a PDF into your inbox.
Well, William, it's been a real pleasure getting to know you. I really enjoyed this. I love reading your stuff, and thank you very much for your time.
Listen, really appreciate your time, and let's just hope let's hope the market continues to behave itself.
I'm sure it will, and you've given us all a lot of great names to watch out, and I am going to go and check out those motorcycles.
You should. Ride safely.
Thanks. Take care. Patrick, it's time for Talking Charts. What do you have for us?
Well, listen, we're going to get through the top 3 things to watch, and then we got Rob Koyfman joining us, and we're going to bring him in to talk some charts and see what he's seeing on the market. So let's quickly, though, start off here and talk about the 3 things we were watching last week. And we asked if there was going to be a short-term top in uranium. And what's interesting is uranium really did have a little bit of a blow off on the upper end, and has more or less been consolidating since. And I don't, I know that Cuppy and yourself have talked a lot about the bull story associated with uranium, and from a fundamental perspective, I'm with you. I'm not in anywhere way bearish in the bigger picture, but it really did go too far too fast, in my opinion. And this kind of mean reverting correction is a very typical thing that happens in the market. The question really is this now finally going to be a buy on dip in this window? And that's something now worth watching, as we've already come off $3-4 off that high. What's your take on it?
The yellow laser eyes. When everyone went yellow laser eyes, that's a sign to sell.
There you go.
Number 2, what do we got?
Number 2, is it a buy on dip on this market correction? And well, the market correction, first of all, did accelerate as we were recording the show into the and into Monday, but really at this stage, we've got a pretty good bounce here. Was that the buy on dip? I think that we have a few more obstacles ahead to really feel that the market has turned, because we've seen many occasions where during corrective phases in the market, I don't want to say bear markets because I don't think it's a bear market, but there are periods in these market corrections where they zigzag, and after they get very oversold, they bounce strongly, and then they have another round of selling. And I don't know whether there's enough evidence to say that the bulls are back at it and it's just all upside from here. So it's I think still vulnerable into next week. But overall, it should be a buy on dip. I don't think that this is going to be a devastating crash or anything, but I would be actually surprised if it didn't end up being a 10% correction on the downside. But I've been waiting for one of those for a lot longer than most, right? What's your take on this?
I think the fact that we were both somewhat negative is the reason it rallied, and I continue to agree with you. So we're probably going to scream to new highs. Okay, number 1, what do we have?
Well, number 1, we were talking about the dollar, right?
Oh, yeah, you've got to finally talk about your dollar. Put it as number 1. And what happened?
Okay, look, it just went and retested the highs, which is a very typical thing for the market to pause on the highs. We even said that last week, Kev. But so far, it hasn't really faded off that high. I mean, one little reversal day and got a green candle back up. I don't know whether you want to already write off a top on the dollar here. This thing could blast off to a multi-month high and be heading to 94, 95 still. I think it's too early
the trouble with the dollar is it's so boring. Like, this barely moves. So
we could talk about the history of the dollar in just a moment when we get to talking history. But
okay, so I'll save it for that. So what do we got for next week? For top 3 things to watch next week?
All right, so we have to talk crude oil in this breakout. I know both Eric over there at Macro Voices and yourself are both quite serious oil bulls.
I've told you before, I don't like it when you talk about them. It makes me too jealous. If we're gonna have this open relationship, we
don't talk about it.
I agree with it, and I'm fine with you doing it, but you just keep it to yourself.
All right, so but look at that breakout. It's for reals.
For reals. Oh God, so you probably Gucci'd it now.
But look, it is okay. There's always a chance it could prairie dog, but this is a fresh breakout. And what I like about this breakout is that as it approached the previous highs, very similar to what the dollar did in some degree or another, it paused and just kind of gave a little bit back and then slingshotted straight to a new high. I still think that right now a move to $78 to $80 on the short-term impulse is entirely on the table. At least I don't see any reason to be fading this move right now. What's your take?
My take is I love it. I've actually.
Oh man, we all agree. This is
it's
dangerous.
a problem. I try not to look at it. I own it, and I try not to look at it. Same with my natty.
Well, you know what? So let's move on to the number 2 thing to watch this week, and that's the little breakout that we had on the 10-year yield, and we've spent almost 2 months trading in an incredibly tight range. Basically 125 to 135 on that 10-year yield, and in this post FOMC little slingshot burst as the yields are suddenly rising, and it's a really interesting thing to watch into next week as to whether this is your favorite bond scenario, which is bonds going down because they have no business going up, right?
That's right. Yeah. One of the things that I think is different about this move is that the positioning was very, very light, meaning very few people were short right now. And I'm just starting to see for the first time now the bond bears jumping on, but it's early and it feels to me like there's a lot more room for people to get on this trade. Whereas, when we go back to March and April, that trade, it was so crowded. It was on the front page of everything. The reality was that almost all the traders had it going on because they thought inflation was coming and yada, yada, yada. This time it feels much different to me. It feels that this move caught a lot of people off guard. And I love moves that people aren't expecting that end up being bigger and are technically significant and very few people are positioned.
Are you thinking like 160, 170 on the yield here?
I'm thinking 2, baby. Like it's going. Anyways, let's get to number 1. What are you watching?
Oh no, listen. I like it. You're bold. You're making bold calls. I like it. Anyway, number 1 is we already talked about it just earlier, but is the market correction already over? And you know what? Like I said, we call it a correction because we don't want to boogeyman it into a bear market or crash or something. But corrections often can even take 3 weeks to even several months, and those are at least those deeper corrections. But is this one of these little 1 week, 2 week little dips and the market blasts off again? I'm still a little cautious, Kev. I'm not ready to already be pushing the chips all back in. I think that the market can create enough volatility and confusion to kind of spook investors on both sides, on the bull and the bear side of that.
I'm fighting it a little bit, and even if it pushes to new highs, I'll be disciplined with my risk. But to me, there's just very little reason to get excited about the market. I look at 2 major themes, which is monetary. To me, there was a monetary hawkish shift, very big one. And I think the market's underestimating how big it was, actually. And then on the fiscal side, I call it the fiscal fatigue. There's just very little desire to get anything done from that perspective. So I combine those 2, let's just say, previously pedal to the metal, full steam, both on the stimulus, are now having the brake applied, or at the very least the pedals coming off. And yeah, sure, stocks might go higher, but they're going to do it without me because I feel like the risk reward is becoming more and more dangerous every single day.
All right. Well, let's get Rob on here and let's talk some charts. So joining us for the second part of Talking Charts here is our good friend, Rob Koyfman. How are you, buddy?
Hey, Patrick, I'm doing well. Thanks for having me on.
Yeah, the last time we were talking was down in Miami, where we met up at the Market Huddle Piss Up and had a couple of drinks. It was great to see you down there.
Absolutely. Yeah, I remember you were wearing your white shoes, your white boat shoes. Looked like you just came off the yacht.
I don't remember that, but anyway, so let's talk some charts. What an interesting time to bring you onto the show to just get a different perspective. I mean, some market volatility coming back here. What's your take on what's going on here in the markets?
Oh man, my take is anything could happen, but my take is that we're sort of in this transition phase from phase 1, where you had this huge monetary stimulus and that ignited the reflation trade. And now the market is digesting its way from the Fed pulling back on some of that stimulus. And kind of based on what I'm seeing and looking at, we're in the mid-cycle period. And mid-cycle period is where kind of the economy continues to grow. The market probably continues higher with a bunch of rotations and a bunch of shakeouts of different investors. But I don't think we're at the end of the cycle. So kind of like my reading of the tea leaves is that we're mid-cycle, we're consolidating a mid-cycle, and there's going to be this kind of very healthy pull and push from to see whether there's enough stimulus to continue with the reflation of assets, but that the path of least resistance is still up.
Yeah, and obviously we had quite a volatile week in the stock market. Do you think that the market correction is over, or is there some vulnerability in your mind for this to head a little bit lower first?
Yeah, I think, I have no idea what's going to happen. Probably if I had to take a stab at it, I think you had a pretty significant shakeout in the market. I think the market has bounced back very quickly over the past kind of previous 5 pullbacks year to date. Seasonality is in the market's favor. So September tends to be the weakest or a weak part of the year. And I think now that we're coming out of September, there's going to be pretty strong seasonal trends pulling the market up. So, if I had to guess, I think kind of the low was in with the Evergrande trade on Monday, and people now Googling China real estate and what the hell that is. I know the sentiment surveys on like AAII got to one of their lowest points of the year last week, and so I think near term the market the bottom's in, and sort of we're going to have a rally into year end.
All right, so let's get to using Koyfman a little bit. So for those of our listeners that didn't pick up on it earlier, Rob is the founder of Koyfman, one of the amazing platforms out there, resources for investors. And why don't you start firing this up and showing us some of these cycle analysis and what you see is going on here in the markets?
Yeah, absolutely. So first thing I wanted to do is kind of like I'm going to be driving Koyfman. It's a web-based platform. We have a bunch of different functionality here, but really I'm going to focus on the graphing part, which is down here, these graphs, and I'm going to pull up a bunch of different assets. So let me start with the S&P 500, our favorite kind of like equity index, and let me pull up the WALCL, which is the Fed balance sheet. And we're going to put that on a separate chart, kind of like to see what's been happening. We're going to zoom out to 20 years, and then we're just going to add jobless claims. So jobless claims, the jobless claims ticker is ICSA. Initial claims. Cool. So just to kind of like give some context, and I'm sure, Patrick, you know this, I'm sure a lot of the people on the listening know this, but in terms of kind of like what happened, obviously you had a huge spike because of COVID. That's now been coming down in terms of jobless claims. So we're almost back to where we were pre-COVID, not yet. Obviously the market's much higher. And now the Fed is tiptoeing around kind of like where to reduce, start reducing their asset purchases, and that's something they've been hinting since June, and that's obviously getting a little bit more aggressive on their part. So from kind of like my perspective, or as I look at it, this Fed stimulus started around here when COVID unfortunately hit our world, and the Fed's been expanding its balance sheet ever since. And the way that I look at it, kind of like reading previous cycles, is we're at this point where the Fed had expanded its balance sheet. There was some stimulus, and now it has to kind of figure out how to slow that down or how to go sideways. And in the previous cycle, when the Fed started slowing down its asset purchases, you always had this sort of consolidation digestion. And the question becomes, how fast is the Fed going to act? So here the Fed acted very gradually. And then even though you had to digest these Fed actions, and there was some Euro crisis in here as well, Euro debt crisis, the market sort of continued its pace, and it continued its pace because policy was still fairly accommodative. And I think you're having a sort of similar scenario here as well, where the Fed is going to start thinking about how to lower these purchases or how to decrease these purchases, and the market will have to digest it and figure it out. But I don't think that we're kind of like, I don't think that we're topping out here. I don't think this is the end of this bull cycle.
Right. So one of the really cool features on Koyfman as well is the sector performance analysis. And what are you seeing in the way that the different sectors are developing?
Yeah. So if I kind of go here under the market dashboards and think about these sectors. So if we just look at kind of like the sector performance year to date, and I just have like all the sectors here highlighted, it's interesting that energy is sort of the best performing sector, but it hasn't been the best performing, kind of like it's had a wild ride. And if you think about the sector that's really most tightly correlated with Fed action, with stimulus, that's really materials. It's the XLB. And you could sort of see that as the Fed started talking about tapering or thinking about on tapering in June, that's sort of where the XLB peaked, and it's been sort of struggling to regain that leadership ever since. So that's a pretty important point. I think going forward, I think the XLB is going to have a very tough time outperforming. One of my favorite trades right now is actually looking to go long energy and short XLB as a pair trade, because I think energy has some secular tailwinds that have to do with kind of lower capex and some constraints in terms of exploration. And if we look at this pair trade on a long short basis, so I'm just going to do XLE versus XLB. So this is going to be the long short trade because I used a colon, and I just pull up a graph here. This is a really nice kind of a huge underperformance of the XLE over a really long period. And then here we have a potential here, inverse head and shoulders setting up. And I do think there's a lot of good reasons for XLE to continue to outperform XLB. This trade isn't entirely beta neutral. There is a little bit of beta, but because you're playing sort of two cyclicals, you're not taking too much cyclical exposure here. So I really like this trade going forward.
That's awesome. And what do you have any insights as to, like, obviously technology and like healthcare have been very strong earlier in the year. They've certainly bumped their head here a little bit on the short term, but you think that their outperformance is also going to continue, or do you have any insights on that?
Yeah, so I think tech has a good chance of outperforming going forward. And the reason I say that is if I look at the yield curve, so if I look at the yield curves, kind of like the twos, the 10s twos over here, which I'm going to find. And if I look at the yield curve over the past 20 years, and we add PMI here as an indicator, and let me go here to econ and add the PMI. So what I see here is, I know you asked me about tech and healthcare, and I'm showing you PMI, but I'll get to that point in a second. What I see here is if I zoom out, that every time kind of like PMI peaks off of a trough. So here in 2021, here 09, here in 2002, 2003, we could actually go back and have a kind of like see a very similar pattern. You basically have a yield curve that steepens and then continues to flatten, and then kind of like steepens, flattens, and then steepens. And I think we have peaked in the yield curve. So I think the yield curve will flatten going forward, because the PMI impulse is basically it's still going to grow, but it's going to start trending towards 50. And we're going to be in this mid-cycle where sort of PMI is going to start. There's not going to be that really huge impulse. And part of the reason that tech underperformed is earlier this year is because of the steepening. Is kind of like as the yield curve steepened, you had this growth trade that was on, and we saw that in the materials outperformance in the first half of this year. Now that kind of growth is going to moderate going forward, and that's depicted by this yield curve flattening going forward. I think basically tech has a good shot of continuing to outperform. So if I look at kind of QQQ versus SPY. We could sort of, if we look at it over the past 5 years, so you could see that these two things versus the yield curve are pretty related, at least over the past year. And so as the yield curve was steepening, basically QQQ was underperforming SPY, and now now I think there's a really good shot that it continue to outperform. So going forward, I think tech looks good. If I actually look at some of these like ARK ETF, I'm just going to delete. If I look at the ARK ETF, which is the Cathie Wood ETF, a lot of high growth names in there, obviously has been consolidating, moving sideways. There's a lot of reasons for this thing. There was a lot of kind of talk of a bubble and overvaluation, and this has held up pretty well. So this is kind of like your very classic consolidation. It had a huge up move. Nothing really bearish about this chart except a big consolidation. And if I actually zoom into this ARK ETF and look at the holdings, if I go here under analytics, this is one of my favorite functions on Koyfman, using this lots of charts feature. So basically you get all these lots of charts as the name applies. And here I could select my ETF here, my ARK ETF. You could see here the constituents in terms of how they look. And a lot of them have sort of started to make new highs or move higher if you look at some of the names. So I think growth and tech is catching a bid as the yield curve relaxes, as growth moderates, and I think that's a trade that could continue to work going forward.
Right. I also like your, you already talked about your 210s. I like the yield curve analysis that you can do on Koyfman. But what's your take? Like, I mean, the 530s were where almost all the big damage and flattening was occurring, while it's largely because the 5-year yield has been pressing so high and the 30-year has been probably the most volatile. But what's your take on the way the yield curve is shaping up here? And do you have any other insights on this?
Yeah, so I do think here that this is this is related to the flattening that I mentioned before. So if we compare kind of like the U.S. yield curve on the 10-year and compare these two, they sort of look similar. You've had this little bit of divergence here, and
it's really been over the last couple of months. Like, so if you really zoom in, it's one kept going down while the other has been consolidating, and that's largely because that 5-year has been sort of the one that's been holding up so well, probably because of inflation expectations, right?
Yeah. So that's a great point. I actually haven't looked at the 5-year. So I guess by definition here we're looking at the yield curve 5-year, then 2-year, right? That's the kind of like delta there. So if we let's move that to its own little graph. And so that's the one that, like you mentioned, that's been sort of rising ever so slightly. So, based on kind of like the tea leaves that I'm reading, I think both of these are basically gonna flatten going forward. So I think you probably had some mispositioning and some positioning cleanup that's been happening over the past couple of months, and that's why this kind of like 5-year, 2-year is acting this way. But kind of like my hunch is that this is going to continue to roll over. One of the stocks that I love following is Freeport, because Freeport is it's a copper company, it's a gold company. It's like you can't have a better reflation market indicator than Freeport, and it's actually like if we look at the relative performance of Freeport versus the market. See here that kind of like this was one of the first stocks in the market that started telling you like there's going to be a reflation, and even though things were really, really bad, like this started acting really well right when the Fed pumped trillions of dollars into the economy, and likewise kind of like in May, June, this thing topped out and it's been this is probably a little bit more than a consolidation. I would call this a reversal. And the other thing is, if you look at it on an absolute basis, like this looks like this looks like a pretty nasty, or it's setting up at least, I think, to be a little bit of a head and shoulders. I think this kind of like neckline really has to break for the head and shoulders to be confirmed. And I would put sort of like the neckline there, the head here, the shoulder here, that may be setting up. But I don't know. Maybe the market will prove me wrong, and maybe the Fed will be more dovish, and this thing is just consolidating and it's going to break out. But sort of like this volume profile, these really big red bars, tell me kind of like something ugly is potentially brewing here. And that's sort of why I think that the yield curve is going to continue to flatten because of this very, very strong and powerful indicator.
Well, when I see you use this platform, it always boggles me how dynamic it is. It's such an amazing platform you've built. Why don't you tell our listeners a little bit about it? Because you've upgraded or created a new paid version part of Koyfman. But why don't you give everyone a rundown of how everything works with your site?
Yeah, absolutely. So Koyfman, just as a quick pitch, is a financial data and analytics platform. I should probably say that without stuttering. And the value that we provide is, one, bring together professional grade data all in one place. And data not only for stocks, but if you click on the search function, you'll see that we have equities, ETFs, mutual funds, indices, bonds, Forex, futures, economic data. And then for equities, we cover all global equities. So not just US, we cover our friends in Canada, we cover Brazil, we cover every other country. For every market outside the US and Canada, it's end of day data, but in the US and Canada, it's streaming live or delayed data. So that's really cool. But the benefit here is really the deep fundamentals we have. So to the extent that any of the listeners are fundamental investors, we have all these like really amazing financials for all the companies that you could look at and that you could graph. So if I wanted to look at kind of the earnings estimates for Freeport, I could do that as well and graph it with the price chart and kind of like see how estimates have been trending over time, in addition to some of the other high quality macro and economic data we have. And then the other thing that's really interesting about our platform is we have a lot of these kind of like market dashboards where we created a way for you to browse the data. So if you wanted to look at currencies and see what's on our platform, you have this currency dashboard. If you wanted to look at global yields and see how global yields are shaping up in the world, we have them all here listed for you to browse so that you don't have to know which ticker to actually graph in the search box. And we have some ways for you to really analyze what's going on with these yield curves. In terms of our platform, we have a really robust free version. So you should sign up for free and you can continue to use it for free. And then we have some functionality and data that's behind a paywall. We have two plans. One plan is $35 a month. Another plan is $70 a month when you pay annually. And that gives you the ability to kind of create your own dashboards. So these are some of the dashboards that I created for myself that include scatter plots or charts or kind of like the way that I look at the market. And you could include, it includes unlimited watch lists as well, where you can have a watch list and then really be able to add different columns like fundamentals and valuation and really have different ways. These are ETFs, so they're not going to have valuation. But if you look at a bunch of stocks, we have a lot of high quality data that we expose and let our users really make important investment decisions with.
Yeah, you know what? When I see your platform, it's just boggles my mind because like for the average person that can't get access to the high end expensive Bloomberg machines, except no substitute to Koyfman, like this is just gets you all this information at your fingertips. It's just an amazing resource, and it's awesome that you created it.
Yeah, thank you, and thanks for kind of your support. You guys were one of the first ones to highlight this platform. I think it was 2 years ago. to your listeners when it was still itty bitty nascent and kind of just getting started. So really appreciate kind of your support. And we still have, I remember we had a bunch of users that signed up after that, after you had me on your show. And then we track how many users stay with us, and we still have a bunch of those users with us. So that's great.
We have smartest listeners and we have the best guests. So there you go.
Awesome. Good combination.
Anyway, all right. Well, Rob, thank you so much for joining us, bud. And we look forward to having you back in the future.
All right. Thanks so much, Patrick.
All right, Patrick, it's time for This Week in Trading History. What do you have in store for us?
All right. Well, this week in trading history, we're going to go back to September 22nd, 1985 for the Plaza Accord. Kev, both of us were around back when this happened. You know,
I know. I was in my parents' basement listening to New Order albums. How about you?
Yeah, no, I was riding a 10-speed around in my parents' driveway, right?
Like, that's how old we are. It was a 10-speed. It wasn't even 12-speed.
We were youngins.
Yeah.
No, it was not. Anyway, so but it's actually really interesting when digging this up because so let's talk about this. So the historic 1985 Plaza Accord signed at the Plaza Hotel in New York City was a pro-growth agreement signed by what was then known as the G5 nations. So it included West Germany, France, the United States, Japan, and the United Kingdom. The purpose was to force the United States to devalue its currency due to a current account deficit approaching an estimated 3% of GDP. More importantly, the European nations and Japan were experiencing enormous current account surpluses, as well as negative GDP growth, threatening external trade and GDP growth in their own home nations. So the world cooperated for the first time by agreeing to revalue the exchange rate system over a 2-year period by each nation's central bank intervening in the currency markets. Target rates were agreed to. The United States experienced about a 50% decline in their currency, while West Germany, France, and UK and Japan saw the opposite appreciation. The Japanese yen in September 1985 was at 242 on that US yen cross, and by 1988 it was down to 120. The same thing happened, obviously, to the German Deutschmark, the French franc, the British pound. These revaluations would naturally benefit developing nations such as Korea and Thailand, as well as South American nations like Brazil, because the trade would flow again. So what gave the Plaza Accord its historic importance was the multitude of firsts in the post-Bretton Woods period. It was the first time central bankers agreed to intervene in the currency markets, the first time the world set the target rates, and the first time for globalization of economies. They did it for that. First, it was also the first time the nations agreed to adjust on their own economies. So arguably, sovereignty was exchanged for globalization. So many argue that globalization started from this event. What's interesting is that this also was a turning point for Japan. Japan felt the worst effects in the long run in its signing of the Plaza Accord. The cheaper money for the Japanese meant easier access to money, along with Bank of Japan's adoption of cheap money policies, everything from lower interest rate, credit expansion, Japanese companies moving offshore. The Japanese would later become, obviously, the world's leading creditor nation. Cheap money policies would obviously create a slower consumption rate, rising land prices, and the creation of an asset bubble that would burst, 4 years later, leading to that period in Japan known as the lost decade. And so it all started with Plaza Accord, and in many ways, do you remember 50% swings in currencies, Kev?
I know, that's when it was exciting. But
yeah,
is your story finished?
Yeah.
Because even more important than the Plaza Accord is, did you realize that The Breakfast Club was released in 1985? The greatest teen movie that has ever been made. There will never be one that good. It really was. It's not even close, and still holds up. A lot of these other, John Hughes got some great movies. Obviously, Ferris Bueller's a terrific one, but The Breakfast Club is by far his best. I could still watch it all day long, and a great soundtrack. And that's
There you go.
that's the most important thing to come out of 1985.
All right. So, Kev, it's time for skin in the game. And, well, you got me.
I did. I actually won one. Very unusual lately, right?
Very unusual.
Yeah.
But so let's quickly review what the bet was. We bet on that Nat Gas, the Widowmaker.
You tried to get me because you thought I was gonna be too bullish, and you thought that you were convinced it was the Eiffel Tower formation, right?
Well, I wasn't convinced. I was giving it an open-ended bet. I was implying that they could have blown off its top, and it was a worthy bet for us to determine whether or not it was going to be the case.
Yeah.
One way or another, you took the bullish angle on it. Let's actually here pull up a chart of what's happening in that. Gas here, and so we got a close here. This is the continuous contract, but it's all we need for this purpose. You can see that it reversed up here into the tail end of the week.
You were actually looking good for a bit, weren't you?
Oh yeah.
I didn't realize that.
It started in my favor.
Oh, okay.
Started in my favor, buddy.
The market gods just wanted to tease you a little bit.
Yeah, that's exactly what happened, and then just like that. But it was a worthy cause. I'm adding a picture to the piss up.
It keeps getting bigger. Okay, so let me tell everyone about the game. So, Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows: a Duke and Duke, a pint of beer, burger bet, pitcher, case of beer, 2-4, as how we call it here in Canada, bottle of wine with a $100 limit, and a steak dinner, which is the granddaddy of them all. The winner of the bet is obligated to create a new bet for the following week. That obviously falls to me. And all wagers settle in full, and there will be no netting of positions. Okay.
Agreed. No netting of positions. It's really important physical delivery of all
yes, that's right.
bets.
So I got to do it. I got to do the U.S. dollar.
Okay, the Dixie.
Okay, the big Dixie. And I'm just trying to think what it is. Can I see a chart?
Yeah.
And can you zoom it out a little?
Yeah, it's 93.
Can you zoom it out though so I can see it? Yeah. Oh, so it's really tried. Okay. One touch.
What do you want to do?
Okay, one touch. Where are we right now? 93 what?
93.27.
Okay. One touch. 94.11.
For next week?
Yeah.
No, I'll take the under.
Rats. Okay. Oh well.
Look,
it's too high.
I think the dollar could break out, but that's
if it breaks out, it's going to touch
thing.
it. But if it breaks out, it's probably going to keep going.
Well, there you go. 94.11. Okay, so obviously.
Do you know what would be interesting? I would love to go and actually look at the volatility and plug it into a one-touch calculator. Like there is a way to price this from an option basis, and I'd love to see what that option is worth and whether.
All right, why don't you
which one
look
of
it
us,
up and report it back next week?
You know what? I'm not an exotic trader. I need some. Okay, so this is what if anyone has a Bloomberg and can walk me through how I price out a one touch for next week that way. DM me on the Bloomberg, and I would love to learn it so that we can figure it out. And I'm really curious to see who's on the right side of the bet because there will be a cost to that, and whether that option's worth 25 or whether it's worth 75.
I want a burger on this one, buddy.
Okay, well, no, let's do pitchers. We got to keep the whole thing up. I'll do a pitcher.
You're gonna go up to a pitcher? Done.
Yeah. Okay,
done. I was trying to.
You were trying to be nice, I guess. I get it, but you know what? The piss up needs some pitchers. Is how I look at it.
There you go.
Yeah.
Okay, so it's time for No Stupid Questions. This is where we get to invite the better of the
true
trio.
star of the show. The true
star of the show. Lena, how are you?
I'm good. How are you?
All right. So, Lena, let's throw some questions.
So the first question of the week. I am too small to be able to afford a Bloomberg terminal, but since I retired, I am a macro enthusiast. Are there any other option to pull data and charts that aren't as expensive? Thanks.
Wait, 1 second. I got something to say. Your height has nothing to do with whether you can afford a Bloomberg terminal or
It's almost like we data mined this question just because we had Rob Koyfman on.
That's right. So the first thing is obviously, I'm going to throw this out there. It's so easy. Rob has obviously Koyfman charts, and it's terrific. It's still free, right?
It's just if you want an additional watch lists and additional
it's still free.
features.
So go check it out. It's amazing. A lot of it, I think he's even called it like the poor man's Bloomberg because
Bloomberg
a lot of the Bloomberg Light. I'm sorry. I should know better than to call it the poor man's Bloomberg. That's not marketing. Sorry, Rob. Anyways, Bloomberg Light is a better way of putting it, and it's a lot of the actual commands are the same. And his whole goal was he was frustrated by the exact same thing that there was this Bloomberg was so expensive, and we thought there was a better way, and he set about making a product for it. Now, having said that, after that shameless plug for Rob's product, I will give you some other ideas. And one of the ideas that I just like to emphasize is that to a large degree, macro trading, much of it doesn't need long-term, staring at charts and staring at ticks and doing that. I would say that if you think back, I know that Lynn Alden, who is a terrific resource, one of the smartest people out there, she has a Bloomberg now, but when we first had her on the show, she did not have a Bloomberg. She did a lot of it. She went and got data from Fred database, which is the Federal Reserve. I don't know what the ED stands for, but it's actually the St. Louis Federal Reserve has a great database. There's a series of different free things to get
resources
out there, and resources. Thanks, Patrick. And if you're trading macro with a longer term view, the reality is that you might not need a Bloomberg. You might not need that if you're trading themes, and so just be aware that just because you have a Bloomberg doesn't it's not necessarily going to make you any more money. Lynn Alden is one of the sharpest cookies out there, and she didn't have a Bloom for many years, and still did some great macro research. So don't let that stop you. And in the meantime, check out Rob's product.
For sure. Okay, so let's go to the next one.
Okay, so second question here. I know that this isn't really your pitch. It's more Cuppy and every fucking person on Twitter right now. But has anyone looked into the storage capacity that Sprott has to keep buying and storing uranium? I mean, GBTC could hoover up all the Bitcoins they wanted to store them on a zip disk on Jeff Bezos' butthole. But this is actually uranium we're talking about. If they buy another $1.3 billion of uranium at an average purchase price of $50 a pound, that's 26 million pounds. So it says here, Lena, please read that in a Dr. Evil voice. And also says here, Kevin, please explain to Lena who Mike Myers is. I know who Mike Myers is. Thank you. How sure are we that Sprott can actually store that much inventory? Thanks as always, and apologies for the F-bombs.
So some great questions there. I think that they can store it if they've created it. I don't think it's as hard as this reader believes. I don't know for sure, but my suspicion is that that's not going to be the limiting factor. What is going to be the limiting factor is if it no longer trades at a premium, you won't see them hoovering up any more uranium. So one of the things to remember is for that uranium to keep growing in terms of the uranium participation company. What is it called now, Patrick? Is it what? It's not that anymore, is it? Sprott, is it Sprott Uranium Fund? I don't know. Anyways,
no,
everyone knows what it's the U.UN.
No, it's the Physical Uranium Trust.
Physical Uranium Trust by Sprott.
Yeah.
For that to continue hoovering up and to eventually getting the 1.3 billion of uranium, it needs to continually trade at a premium to NAV, meaning that they need to be able to issue shares and then buy the uranium. Right now, it is no longer trading, or last I looked, it was no longer trading at a premium to NAV. So therefore, it's not going to be hoovering up any uranium. And that, to me, is probably the more limiting factor than the physical storage.
Right. Makes sense. All right. So let's do the last question here, Lena.
So last question here. Firstly, thanks for the highbrow entertainment and all these reviews of beers that we will never see in our stores outside of North America. We give thanks. I think there's a typo here. We give thanks for seeing the banana beer types. However,
the banana beer was a good beer.
Good.
I'm sorry to interrupt
really
here,
it.
but I'm going to hang in here. Patrick hated it Lena and I loved it.
It was off. The banana beer was awful.
No.
And
No.
it should have never.
I agree.
should have never
Most fruit should not be introduced with beer, but bananas for some reason
It was
work.
great. However, you are letting the side down. No Canada in this ranking chart. There, he's included this chart over here. But could we please hear a pronunciation speak-off between Kevin and Patrick for the title of the chart?
Okay, so there is a serious question following, but let's try to do this while it's still in our minds here. This is
So top three countries are Spain, Italy, and Poland.
Okay. And so sorry, we didn't say what the chart was, Lena. It's the share of survey respondents that they say they drink beer regularly. Okay. I was very shocked to find we were not in this chart, and I looked it up, and we are not holding our own. We are. It's actually quite disappointing how far Canada is down this road.
It is. Canadian beer drinking is.
I don't know. I thought we were big drinkers. I thought that it was all the northern countries that didn't have a lot of light. But
I think it's because we drink during cottage season. And that's very short every year.
I was actually wondering if it's because we made marijuana legal because it seems to me when you're walking around Toronto that nobody drinks beer. They're all high now. But anyways, so let's just say who they were. Number one was Spain. Who knew? Number two is Italy. I would have thought they drank wine, but I guess they're also drinking beer. Peroni, a great beer, though, by the way. Poland. Now, so Poland, I understand. UK, I understand. Germany, I understand. France, a little bit surprising. Switzerland next. And then the United States. So we are like stinking here because we're like America's beat us. China's beat us for fuck's sake. Look at that. They drink more beer than us. So I don't know. Patrick and I and Lena are doing our part, but obviously the rest of Canada is not holding their own. And as far as the I guess we're going to try to read this. I don't know. It's not really fair if I go first. And then you want to go first? Okay, you go first, Patrick.
Salud.
Okay.
Saluti.
Yeah.
I think. And Tvoje zdraví.
Okay, so now this is bullshit because you speak some sort of Eastern language or something because I can't do it. I'm not even going to try.
I think it's Tvoje zdrowie.
Tvoje zdravie.
God.
Oh, yes,
that's what happens when I
Polish.
marry a Polish dude.
Yeah.
I checked in with him.
There you go. Okay.
So now the
real question.
If interest rates continue to be suppressed, why can't banks improve their margins when demanding velocity return by raising rates for all customers who cannot access the bond markets as borrowers? Cheers.
Great question, and I think it will happen. If you got financial repression at a level, let's just say the government said the 10-year is going to trade no higher than 1.5, and there was a rip-roaring economy with all sorts of demand for credit, there very well could be another tier of free market rates, quote unquote, and that free market rate could be significantly different than the government rate. And the government rate would, in essence, just be the Federal Reserve and people that were mandated by law that they have to purchase it, buying it.
Right.
So it's a great question, and the reality is that it is in an era of extreme financial repression. It's not only why can't they do that? It most likely will happen.
Well, there you go.
Okay.
I won't push back on that. Anyway, that's so Lena, where can people submit their questions?
If you have any questions for Kevin and Patrick or any of those dares that you'd like Kevin and Patrick to perform, please submit your questions to nostupidquestions@markethuddle.com.
Okay.
Oh, there you go.
So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle. That's Lena is in charge of that, and she does get tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals, and while you're there, please like and subscribe to get our latest content. And please, if you could, rate and review us on iTunes. You guys know why. And not only that, I get a kick out of reading them. So it's been a while. I'd like some new ones so that there's something funny to read. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna or at bigpicturetrading.com. And Kev, where can they find you?
I'm on Twitter at Kevin Muir, M-U-I-R, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. Okay. So, Patrick, I know you have a big night out, so we won't hold you too much. What you got to tell us about your beer?
Well, listen, this is a clean, crisp Pilsner, 7.9. It's and sessionable. There's that word.
Yeah.
It's,
Are you giving us your score, or you're telling us it's 7.9 alcohol?
No, it's like a 5%. Beer.
Oh, okay. So you're giving it a 7.9.
What are you rating yours?
Oh, well, I got to rate it the same, which I can't remember. I think I said 8.1 last time, so I'm sticking with 8.1.
Okay. Oh, is it all the same type?
Yeah. Well, my buddy Andy sent me these. Andy's the nicest guy in the world. He sent me way too many of them, so I got to. Well, not way too.
There's
many.
never way.
I have
too many.
to. That's right. I shouldn't say that, but I do have to do. I have to pile.
You have to do your part. You have to do your part to get Canadian.
Yeah. How disappointing was that? I was really disappointing. I really thought that maybe it's alcohol and it's not just beer. Maybe if we look at alcohol per capita,
I'm pretty sure it said beer. I thought.
No. That thing is beer. But what I'm saying is that I thought that when you looked at the alcohol consumption by country, and you're laughing, Lena, saying that it has that I thought it was all the countries where it's dark. It's usually countries that are up north, and there's not as much light. Like, for some reason, Sweden are big drinkers.
It's cold. You want to keep
Russia
warm,
obviously
right?
is. Yeah. Well, I think there's nothing else to do. It's like dark, and you're like, oh, geez. It's like, think about it. When you're like in Sweden, some parts of Sweden, it'll get dark at,
I think it's dark for like
5 o'clock,
like 20 hours or something.
4 o'clock.
Some.
Yeah. Yeah, like my brother was actually working in northern Sweden for a while, and he said he didn't see the sun. It's difficult in the winter. It's kind of depressing. So that's why people drink more in these places. And I thought we as Canadians, we stuck to that. And so I was fully expecting us to at least be ahead of the Americans. We're not even ahead of the Americans, nor the Chinese.
Yeah, that was a surprise.
I got to think that's bad data. That's bad data. Just like, don't you think that's?
I don't trust this stuff.
I don't trust it either. It's just like
all right.
They figured something out. Anyways, Patrick, we know you have a big night out, so we'll let you go.
All right.
Thanks for tuning in,
guys.
everyone, and we'll see you next week.